Hi everyone, this is the Piaggio project and this is our table of content. I will begin introducing you the business model of Piaggio. Piaggio was established in 1884 and is Europe's largest scooter and motorcycle manufacturer and one of the world leaders in the industry. The company is based in Italy and has three distinct areas of activity. The first two concern two-wheelers and commercial vehicles, while the last one concerns robotic division. Piaggio manufactures two-wheelers with a range of products including motorcycle, mopeds and scooters, marketed under several brands. It also operates in the 3-4 transport sectors with its range of commercial vehicles. Nowadays, manufacturers are shifting to smaller and more affordable scooters, complying with the needs of the younger generation of consumers.
Okay, so now we're going to analyze the competitive landscape of the motorcycle industry. The global market has been growing over time with an expected growth of 6.1% between 2021 and 2026. The leading of the market is represented by Honda, while Piaggio owns only the 0.7% of the global market. The firm is increasing its presence mainly in Middle East, Europe, Pacific Asia, America and India. The values of the company are basically integrity, transparency, equal opportunity, respect for the individuals, diversity and inclusion. The company is driven by different competitive advantages as brand image, quality of the product, technology and innovation and distinctiveness of the design.
Now we focus on the income statement. The graphic shows its trends. Until 2019, cost of raw material remains stable, while cost for financing and leasing remain constant over the period analyzed. So the increase in the revenue is due to the increase in the sales that in Piaggio compose all of net revenues that increase since 2015. Now we focus on cash flow. About cash flow from operation, we can say that profits have increased over time, while gain on disposal of property, plant and equipment are decreasing. Focusing on the cash flow from investing, we can say that the company has never substantially reduced its investment in the business and nearly 2/3 of its outflow came from investing activities. Regarding cash flow from financing, Piaggio at the moment is financed by acquiring debt. Piaggio, especially in 2019, looks like to moving in the right direction as a mature firm.
Now let's go in deeper with the analysis of Piaggio. Firstly, we are going to talk about the managerial side of the analysis, starting from the DuPont pyramid. We start from the ROE, which defines the overall performance of the company. As we can see, it has been growing steadily. In addition to this trend, the good value of the ROE can be proved comparing it with the fair ROE, which is always lower than the ROE. This means that the expectations on the return of the company have always been satisfied, also in accordance with the company's risk. Looking at the operating part of the first breakdown, we must look at the ROI, which defines the operating performance of the company. The value has always been low. The positive aspect is that it has been growing. To understand this low value, we can look at the second breakdown. About the ROS, which identifies the efficiency of the company, we can immediately see that it is very low, especially if compared to the manufacturing target, which is 10%, and therefore defines Piaggio as not efficient. On the other hand, if we look at the asset turnover, which measures the effectiveness of the company, we can see that the company is effective because the asset turnover is greater than 1. The problem, which probably causes the inadequate value of the ROI, is that despite the company is effective, it is not efficient, and therefore the good effectiveness is not optimized because of the lack of efficiency. The asset turnover can be divided in two sides. The first one is the analysis on the short-term capital. If we see the average stock period, which involves the management of the inventories, we can notice a high value that in fact the company has been reducing during the years. Despite this high value, the management of the credits and debts has always been excellent, determining a duration of working capital always negative. This means that the company is stable and can well manage the operating cycle in order to receive before the money and they pay its debts. About the analysis of the long-term capital, we can say that because the fixed operating assets have never changed substantially, the growth can be attributed to the higher revenues, which maybe define the possibility that the previous investments are starting to be effective. If we go out of the pyramid, we can analyze the liquidity of the company, which in all of the three ratios has always been under the target values represented above. The most worrying ratio is the quick ratio, the period of the inventories, which play a central role in the current ratio, which should be higher than 1, because otherwise the company can cover the current liabilities in a case in which the creditors require an immediate payment. What therefore saves this company? The fact that it is able to well manage the short-term trade debts, as seen before, with the duration of working capital. In fact, even if in shortage of liquidity, the company can count on a managerial strength in delaying the payment of the debts, and therefore reduce the possibility of a lack of liquidity. So we should ask ourselves how the overall performance of the company is so high. The reasons can be explained with the following values. If we calculate the financial leverage, we can see that it is always negative. This means that the financial structure, D over E, has a negative impact on the overall performance. If we calculate the ROCE and we subtract the RNOA, we get a portion of the return that is linked to the financial activity, divided in financial structure and financial investments. But if we know that the financial structure has a negative impact, we can say that the positive difference can be mainly attributable to the financial investments, which, in fact, if seen in the income statement, determine always a high portion of the return.
Now let's move to the solidity analysis. The first level is composed by two ratios. The equity over fixed asset ratio between 2015 and 2019 has always been around 0.34, which means that 30% of the fixed asset were financed with the equity of the company. Now we know that if equity plus long-term debt over fixed asset ratio is higher than 1, it's a sign of an healthy company. However, in the 5 years considered, it has been between 0.98 and 0.85 due to an increase of 10.25% of the fixed asset, not balanced with a proportional growth of the denominator. This could cause several problems to the company, as it means that fixed assets, which need time to generate liquidity, are financed with short-term debts, which on the contrary ask for an immediate payment. Now let's move on to the second level analysis, which has two main focuses, debts and equity. Regarding debts, we will analyze the second ratio. As we know, if financial debts over equity is greater than 2, the company is deemed financially risky. However, even if between 2015 and 2019 it has never triggered the threshold, the NFO over CAC ratio has been higher than 1, suggesting us that the financial assets were not sufficient to cover a potential increase in the financial liabilities. Regarding the assets, between 2015 and 2019, Piaggio has always kept a level of 75% of non-current assets and consequently around 25% of current assets.
We now focus on the analyst pyramid of the consolidated company. The ROCE increased significantly considering that it was the 3.30% in 2016 and 11.49% in 2019. This was caused by an increase in the net income over time due to higher revenues. Furthermore, the increase between 2017 and 2018, the plus 186%, was caused not only by an increase in operating income but also by a lower depreciation and amortization and a less negative impact of the other comprehensive income. RNOA also increased from 2015 to 2019, reaching the 8.09%, as NOPAT increased due to higher sales and the NOA decreased to an increase of the operating liabilities caused by the trade payables. Profit margin and asset turnover also increased from 2015 to 2019. The profit margin, as we know, is a proxy of the efficiency of the business because taxes are not an operating cost. In this case, the increase of the profit margin is given by the increase of the NOPAT, which was higher than the increase of the sales. The company has become more effective over the year, and this is reflected by the increase of the asset turnover. The ROCE in the analyst version can also be calculated through the analysis of the financial activity, which includes the financial structure and the financial investments. In this ROCE calculation, a key role is played by the spread, which is given by the difference between the RNOA and the MDC, which are the net borrowing costs. We can see that in 2015, 2016 and 2017 the spread was negative. This means that an increase in the financial leverage given by the formula NFO divided by common shareholder equity caused a decrease in the ROCE. In 2018 the spread became positive due to an increase in the RNOA and a decrease in the net borrowing costs given by a sharp decrease in the net financial expenses after taxes. In this case, with a positive spread an increase in financial leverage causes an increase in the ROCE. Despite this, between the 2017 and 2018, financial leverage decreased from 1.13 to 1.06, and this offset a greater increase that could have been there for ROCE.
We identified the group of peers by looking at Piaggio's main competitors, Honda, Yamaha and Suzuki. It is important though to recognize that those companies are important players not only in the motorcycle industry but also in the automotive and engine production sectors. In fact, most relevant discrepancies in the analysis between Piaggio and its competitors are precisely attributable to this fact. For example, the asset turnover ratio is twice as high for Piaggio than for the competitors, only because the net operating assets are calculated in a different way depending on the different businesses the companies are in. Again, the days sales in receivable, which are far lower for Piaggio, falls under the same reasoning. The book value per share for Piaggio is instead significantly lower because Piaggio's standing at a global level is lower if compared with Honda or Yamaha, which are the global leaders in the motorcycle industry, or Suzuki, which is in both automotive and motorcycle industries. Nevertheless, the companies we picked ended up to be an overall good benchmark. In fact, EBITDA and EBIT margins are in the average, while pre-tax profit margin is significantly lower due to the fact that the company is more leveraged than its competitors, meaning a higher debt-to-equity ratio. Another criticality emerges from the current ratio that remains low during the whole span of time we analyzed, and it confirms the fact that the company should increase its liquidity. Finally, it's important to underline that Piaggio's effort through time to align its return on equity to its peers, a goal that was reached only in 2019.
Going on with our benchmark analysis, we introduced the multiple comparables method with the aim of estimating an average market value for Piaggio starting from some average competitors' measures. We looked for an historical of price on book value and price on sales and price on earning ratio for Piaggio and just on the 2019 data for Honda, Yamaha and Suzuki. In addition, we also considered some multiples built on the enterprise value, which incorporate the debt that the company has taken over, while the market capitalization only considers the equity. We compute the mean and the median of these competitors' multiples, and then by multiplying them with the Piaggio's number, we have been able to estimate its market value and enterprise value. From our estimates, market value coming from the average is the closest to the Piaggio's in the 2019, while the enterprise value is lower than the market capitalization, and this is something that is generally preferred, because it means that the firm has a low level of debts, and so it's perceived as it is low riskier.
The balance sheet doesn't capture all the firm values, so how do we calculate it? We apply the residual earning model to find the premium, which added to the equity book value can give us an estimation of Piaggio market cap. Here are all the steps we carry out in the slides. Given our new firm value, the price to book ratio is equal to 1.59. We would not advise either holding or buying Piaggio shares in 2019 because traded shares seem to be overpriced. However, if we expand the time horizon of our analysis by introducing the perpetual value of residual earnings, we find an intrinsic price to book value of 6.25. Definitely a more encouraging value or score for people who were thinking to invest in Piaggio in 2019. To understand this discrepancy between these two values, we should focus on a couple of things. The fair ROI ahead is quite low, which means that the present perpetual residual earning is not heavily affected by discounts. We did not consider growth rate while computing the second price to book ratio because it seemed a rating overestimation with that fair ROI, and also because for the macroeconomic risk we're facing, forecasts which go beyond 2024 have too much uncertainty embedded in them.
In conclusion, from the managerial perspective of the parent company, some values could be improved. The inventories determines an high average stock period and have an high impact on the current ratio. The liquidity ratio, despite the good operating cycles, should be grown. But however, we have notified an improvement of the weak spots. For what concerns the analyst point of view, the consolidated company had a positive trend during the years of analysis in all the main ratio. From the perspective of financial activities, certainly it is important to note that 2018 the spread between the RNOA and NDC became positive, causing a strong increase ROCE.
From the benchmarking with competitors, Piaggio's financial expenses are higher than competitors' ones, and that heavily affected the net profit margin. With the multi-price comparable valuation, we found out that the market is undervaluing the company, so should be good to buy the shares. The same with the residual earning valuation over a long period. This is the end of our presentation. Thanks for the attention.